So today we are talking to you about the impacts of the falling Canadian dollar and the benefits and the drawbacks that it has on the Canadian economy and eventually on the real estate market. That might be your interest, of course, since our channel is mainly real estate focused. And today I'm here with my business partner Mark, in case this is the first video that you're watching in my channel. Mark, can you introduce yourself?
Hey everyone, I'm Mark. Happy New Year, all the best. And me and Ari hope to touch base on the Canadian dollar today and give you some smart information.
Thanks, Mark. So the value of the Canadian dollar against the United States dollar is the crucial economic indicator, and it's reflecting the dynamic of international trade, investor sentiment, and also the monetary policies. When the Canadian dollar drops compared to the US dollar, it creates a mix of benefits and challenges for Canada's economy, industries, and basically consumers. So let's break it down. First, we are going to talk about the benefits of the weaker Canadian dollar. The first benefit is going to be the boost to exports. So a lower Canadian dollar makes the Canadian goods and services more competitive internationally. So especially in the United States market, which is Canada's largest trading partner. For example, in the manufacturing sector, the Canadian produced goods like cars, machinery, and industrial equipment becomes cheaper for the US buyers. This encourages higher demand and increases production. And when it gets to agriculture and natural resources, it's pretty much the same. The export of commodities such as wheat, lumber, oil, and also minerals can also benefit from the lower prices in global markets. For example, during the 2008 and 2009 recession, a weaker Canadian dollar supported Canada's oil and gas export, basically cushioning the blow of the declining global demand. And Mark, do you like to talk about the next one?
Yes, the next benefit would be tourism and hospitality. International tourists, particularly from the US, find Canada more affordable when the Canadian dollar drops. Destinations like Banff, Toronto, and Vancouver tend to see an influx of visitors eager to take advantage of their stronger currency versus the Canadian dollar. The 2015 drop in the Canadian dollar coincided with a record surge in tourism, boosting all the local economies for major cities in Canada.
Yeah, and let's say the other benefit that comes from a weaker Canadian dollar is that it encourages domestic spending. So a weaker dollar incentivizes the Canadians to buy Canadian goods rather than shop or travel abroad. They're going to keep their money circulating within the Canadian economy. This benefits local retailers, mom and shop pubs, and basically domestic manufacturers, and also tourism operators, let's say smaller hotels and local touristy spots.
Another great benefit of the weaker Canadian dollar is job creation in export-dependent sectors. Demand for Canadian export rises, and companies in the industries of manufacturing, mining, and agriculture often expand to meet the demand. This leads to job creation and lower unemployment in export-heavy regions like Ontario and Alberta.
Thanks, Mark. So these were basically pretty much the benefits of a weaker Canadian dollar. Now let's talk about the dark side of the equation. So let's talk about the dark drawbacks of a weaker Canadian dollar, Mark. So one of the drawbacks that comes to the mind in the dark side of this equation is that the higher basically import cost. When the Canadian dollar weakens, imported goods become more expensive, obviously. Canada basically relies heavily on imports for many products, including, let's say, consumer electronics, for example, smartphones, laptops, iPads, stuff like that, and also processed food and beverages that we use on a daily basis, and also machinery and parts that are used in manufacturing. So rising import costs can lead to a higher price for consumer, and that's going to drive inflation, unfortunately. For example, during the mid-2010s, the Canadian dollar decline against the United States dollar pushed up the prices of fruit, vegetables, and other imported basically food that affected the household budgets.
Another negative for the Canadian dollar being weaker is costlier travel for Canadians. Canadians traveling abroad, particularly to the US, find their purchasing power has diminished. A trip to Florida or New York becomes significantly more expensive, discouraging international travel and potentially impacting personal consumption as well.
To follow that, another issue that we're going to have is the higher energy prices. So although Canada is a major oil producer, domestic energy prices often correlates with the global benchmarks priced in the United States dollar. So a weaker Canadian dollar can make basically imported fuels such as refined gasoline costlier, and that's going to lead to a higher transportation and heating expenses for Canadian households.
And here's another big one that's affecting Canadians right now, is the increase in debt servicing costs. If the Canadian dollar weakens and the Bank of Canada raises interest rates to counter inflation, borrowing costs for Canadian businesses and households will rise. Those with debts denominated in foreign currencies would also face higher repayment costs.
Another point that is very important, and I'm assuming that you that are watching this video is most probably investor in one of these sectors, either real estate or stock market. One of the biggest impacts that we are going to see is on the investor sentiment and also capital flight. So what do I mean by that is that a falling Canadian dollar can sometimes signal broader economic concerns, promoting the foreign investors or domestic investors to move the capital elsewhere, so let's say down south to the United States. And this could reduce investment in Canadian industries, real estate, and infrastructure. Now we are gonna give you a few examples of the time that Canadian dollar depreciated compared to the United States dollar. One example that I would like to mention, Mark, is that early 2000s. In the early 2000s, the Canadian dollar dropped near historic lows, trading at approximately 0.62 USD, which was in 2002, if I'm correct. This basically coincided with a surge in the export, particularly in the automotives and manufacturing sectors. The weaker Canadian dollar helped Ontario's manufacturing industry to recover from a global slowdown, and it created jobs and basically boosted the GDP. Mark, do you like to give us another example on that?
Another example would be the 2015 oil price crash. When oil prices fell in 2014 and 2015, the Canadian dollar depreciated significantly against the USD. While this hurt Alberta's oil sector, it gave a competitive advantage to exporters of non-energy goods, and at the same time, Canadian tourism boomed as US visitors flooded into the country.
So another instance or another example of this was during COVID-19 pandemic. So during the early months of the COVID-19 pandemic, let's say in 2020, the Canadian dollar dropped due to the global uncertainty and declining oil prices. So that resulted in exports, basically dependent industries and domestic tourism, particularly to offset the economic fallout. But higher costs for imports like basically medical supplies showed us how vulnerable the economy was back at the time in 2020 when it came to the weaker Canadian dollar.
And balancing the impacts. While a weaker Canadian dollar can provide much needed boost to exports, tourism, and local industry, it also comes with its trade-offs, like higher import costs and cost inflation. The key to maximizing benefits while minimizing the drawbacks lies in managing economic policy strategically. For example, export-heavy provinces like Quebec and Ontario can leverage a weak Canadian dollar to increase production and jobs. Policymakers can address inflationary pressures through targeted subsidies or tax relief for consumers.
In order to reach to a conclusion, let's talk about the whole thing. The drop in the Canadian dollar is a double-edged sword. On one hand, it strengthens the export-driven industries and it basically bolsters the tourism and it encourages local spending, which is going to drive economic growth. But on the other hand, it raises import costs and impacts the consumer purchasing power and also presents challenges for businesses reliant on foreign goods. Not to mention about the capital flight, which is a huge indicator that we are not going to see right away, but it's a risk, especially if you're an investor working in these markets. So all in all, Canada's diverse economy has shown resilience during the periods of Canadian dollar depreciating in the past, and with proper management, we think it can turn a weaker dollar into an opportunity for growth or innovation and job creation. Hopefully our politicians use this as an opportunity. So if you enjoyed today's video, please share it with your friends, subscribe to our channels, and hope to see you soon again.
And we hope you got some great information out of this video. Hopefully we talk soon. Thanks so much for watching.